Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Julian Emanuel with us right now. I can't, let me frame this for you folks about how I cheat every day. It is widely understood. I don't have an original thought. I read and read and read, and when earnings season starts, there's not a second or a third read. Julian Emanuel is the first read of the moment as he parses out earnings. It's like an Evercore ISI thing. It's like 2 paragraphs long, that's all. He speaks English, it's great. He joins us in the studio right now. Everybody's double-digit earnings, 12%, 14%. But come on, it always ends in tears. You're beneath that. How beneath double-digit earnings forward are you?
So we're forecasting 9.6%. But the good news is that when you look at the way things tend to progress, you're always over-optimistic in terms of bottom-up estimates at the start of the year or the year prior, and they tend to fall. They haven't the last few years because of sort of post-pandemic effects, but we think this is going to be part of the return to normal.
Yeah. Paul wants to jump in here, but I got to ask, were you at 10.1 and Hyman got out the the little black pen and just crossed it out and wrote it 9.6?
We don't round.
We don't round. All right. So, Julian, given that kind of earnings, I know I'm sure you put out your 2025 outlook. What's your 2025 S&P target?
6,800.
And how do we get there?
We get there a combination of things. The things that have led this bull market cycle are going to continue to lead, albeit with more volatility than we've seen, because at 25 times earnings in the aggregate index, there's going to be more volatility by definition. The Trump administration will cause more volatility, as they did in 2018 when we were talking about taxes, tariffs, and the border. And small caps. For us, small caps are underloved, overlooked. There have been flows. We think there's further to go.
So like at 6,100, you're going to 6,800. How does your equity analysis dovetail in to Edward S. Hyman's economic analysis right now?
So Ed has basically been very consistent on his inflation call. He continues to think that the trend of inflation is lower. Now, the way we think about the data the last couple months, and you'll remember going back to March and April, you had that sticky patch where there was skepticism that inflation would continue to move lower. It roiled the stock market briefly. That's how we see the next number of weeks evolving, but that course is set towards 2%.
Did you guys change or alter your outlook the day after the election? Did that change any way you're thinking about 2025?
We did.
Okay.
We did. And it's less about Republican or Democrat, though, the evidence is relatively clear that, certainly from a deregulation standpoint, that the Trump administration is likely to be more business friendly. But the biggest thing for us was the clarity of the outcome. Okay. The fact that we weren't having contested politics or anything, that freed up the animal spirits.
What sectors do I need to lead? I've had 2 years where the S&P's grown 20%. I mean, do we not take a breather, or do the AI tech continue to lead us forward?
So we think that what has led will continue to lead: consumer discretionary, communication services, and infotech. It is part, if you think about how bull markets develop, what this bull market is missing that you have in every bull market is a sense of, sort of wild-eyed enthusiasm. You can argue that there are parts of the market that we've seen in recent weeks that have had that kind of wild-eyed enthusiasm. Certainly anything to do with cryptocurrencies or anything like that. But those are small in market cap, and the way to think about that is like the meme stocks, SPACs, and profitless tech in 2021. Those can top, but the bull market leaders continue to lead through the year.
Which fact, don't give me this momentum stuff. Julian Emanuel is as far away from momentum as I've ever seen. Is there a factor that sticks out right now, or is it just earnings and cash flow?
So actually, the factor work that we've done is the biggest sort of long-term theme is stocks that are able to buy their stock back, high buybacks.
Thank you.
Because if you think about it, is regardless of how this landing unfolds, if it becomes
if you have fewer
bumpy,
shares, it works.
right, and you have the cash to actually support, cushion the volatility in your stock.
Julian Emanuel darkened the door and had the privilege of working for Bill Priest years ago. How does he treat free cash flow versus different from mere mortals?
It is literally the Bible of the rationale for investing in corporate America. And it's actually more than that when you think about it. I worked at a company called BEA Associates, which Bill Priest was one of the founding partners in the late 1990s. And the interesting confluence of that is you've had two back-to-back 20% plus years for the first time since the late 1990s. And that's the kind of environment that we're in. And that's the kind of environment that dictates an even greater focus on the idea of free cash flow.
How do you tell good free cash flow from bad free cash flow? That basically is 1/3 of his book.
Well, in my opinion, is the way you do it goes back to buybacks. If companies are actually making the statement that they're able to buy back their stock, then you know that the quality of the cash flow in aggregate is better than not.
Which brings me to my interesting free cash flow buyback conundrum. If I'm Apple Computer and I got gobs and gobs of free cash flow, yet I've got a dividend yield less than 1%. What's up with that? What's Tim Cook thinking over there?
So the academic literature is mixed. Okay, you can make the case that in an environment where the Fed has restored a price of money, that there may be a greater premium in the future for dividends, at least psychologically, but that's not the case for now. And again, when we think about it and we think about what the last couple years have entailed, and that has been 2023, we all thought the recession was coming. It didn't. 2024, it seems like there's soft landing is the mantra, but we know that recessions happen cyclically, whether you're in the roaring 1920s, the 1950s, the 1990s, really the only period where you had a prolonged time without a recession. That's where you want to know that you're able to buy your stock back, that you're able to be creative in the ways that you compensate shareholders.
Is AI still a trade for you? And if so, how do you play it? Or has it already been played out with the NVIDIAs of the world? But Broadcom's kind of shown in the last few days that maybe there's still legs to it.
Well, so our view is it actually isn't a trade.
Okay.
It is buy and hold secular theme. And what the interesting thing is that if you look at the last year or two, we've had this bump in productivity that really hasn't been attributable to AI. And it's our view that when you think about 2025, the upside surprise is likely to come by how much and in what kind of creative ways corporate America actually deploys AI.
So is it still kind of, some people are just feeling like, all right, I kind of got the euphoria of, boy, that people are going to spend a lot of money on this AI thing and there's a lot of CapEx. But now the question is, are some of these companies getting a return on this capital spending? Could that be a headwind for just the theme?
Well, when you think about our thesis of volatility in an up market, there will be times when the perception is that, and the AI leader, the leading stock, as we all know, has really not been performing terribly well the last couple of months. So that encourages that kind of psychology. We think those are temporary potholes with a long-term trend that's got a lot further to run.
Brian Belsky, the other day, like you have to participate in the market. You got to be in the market. You got to enjoy the bull market. Belsky of BMO makes the distinction of a cyclical bull market versus something most people without gray hair don't know, which is a structural bull market. Ed Hyman and I, of a vintage, remember structural bull markets. Do you agree there's a permanence to this? Just based on American GDP, our nominal GDP, and the productivity that Lisa Mateo just mentioned?
So it is certainly what the ongoing tailwind into 2025. But I will say that a lot of our client conversations center around, the durability of the American preeminence and how and when do you reallocate towards the rest of the world?
Towards international. How could
Right.
you do that with the strong dollar that we've got? What
You can't.
what does that say?
You can't. You can't. We are waiting for two things: a turn in the dollar, which perhaps a geopolitical resolution between Russia and Ukraine catalyzes. The other thing that we're waiting for is a turn higher in China bond yields. China bond yields should be worrying people because it looks a lot like Japan in the 90s.
I retweeted that last night. It was shocking. A second derivative of that deflation. Mohammed Al-Arian featured it this morning at Cambridge. I mean, what does the China second derivative of yield signal to Julian Emanuel?
Well, in fact, as it's been for the most part for a number of years, it could actually be the thing that causes the catalyst that causes the resumption of inflation to continue falling in this country. Although, in large part to us, it really is something that's more concerning because it's clearly a
Paul, get one more
geopolitical
in here,
hotspot.
Julian.
All right, do I have a valuation concern here? Is that a headwind for me, or do I strip out the Mag 7 and I'm okay?
If you don't have a valuation concern, that's where we want to start being defensive.
Okay.
A lot of our clients are really focused on that, as they should be, as they should have been the entire year. But again, valuation alone doesn't end the bull. It's either recession or irrational exuberance, and we don't see either of those on the horizon.
This has been great. Don't be a stranger. Thank you so much for all your
Happy
work for
holidays.
surveillance and the issue. Julian Emanuel, I can't say enough about his work. We protect the copyright of all of our guests. Evercore ISI literature from Hyman and Emanuel. Go to them for it. They are the great shop over there in the vicinity of Fifth Avenue. To go from Julian Emanuel to William Priest is What's It's About. Mr. Emanuel, he's chairman at TD Epoch. I don't know if he's emeritus or whatever. He's like Bill Priest. I can't see Bill Priest doing anything but working your basic 70-hour work week. I mean, that's the way he rolls.
I'm with him on that one.
But I just put the book out on Twitter, on LinkedIn, Free Cash Flow and Shareholder Yield. It is a rite of passage. It's short. It's not, 800 pages of Fibonacci calculus. It's really short, really direct, and also somewhat controversial. I really want to point that out. But to have Bill Priest with us after Julian Emanuel is what the show's about.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Meghan Robson has no idea who Rob Thomas is, her Matchbox 20, and joins us from BNP Paribas today.
Good morning.
Your note clearly doesn't say 6%. We're here at higher yields. What events would it take to get a breakout really back to 2004 yields? What would be that cataclysmic event?
Well, first of all, good morning. Thanks for having me. I think that the scenario, I haven't read the report, but
Neither
I think
have I.
The scenario,
It's Bloomberg surveillance. We don't read reports. Continue.
I think that, we're looking a lot at the risks of potential tariffs. And I think that seeing a reacceleration of inflation, if we see a spike in break-even yields as a result of new tariffs, but then additionally that causing the Fed to either pause or resume a hiking cycle would cause even rise in real yields. So I think that's really the bear case for next year. At BNP, we're not as severe as that, but I think we are out of consensus. We're calling for a pause in Fed rate hikes all throughout 2025.
Can I make some news? A pause on Wednesday? Please help me.
Not a pause on Wednesday.
Damn.
So we still think a 25 basis point cut, but they set the stage for an extended pause into 2025. I do think that this would be cause a credit spread widening, but one that we would buy. Whereas the other scenario you painted would likely be the start of a new bear market for credit if we did see rates that high.
U.S. corporate high yield up 8.85% year-to-date total return. U.S. leverage loan index, these are the Bloomberg indexes, which we paid good money for, 8.69%. Man, that's great returns in the high yield and leverage loan market. Does that continue in 25, do you think?
So we don't think that you're going to duplicate that positive of returns, but we do think it's a carry year for credit. So I think that you have a couple tailwinds at your back. The first is still this yield story. So yields are high. We're forecasting the 465 on the 10-year next year. That means that yield demand, pension funds, insurance companies, some foreign buyers are still going to come into the credit market. At the same time, you can see supply accelerate as a result of some of these pro-business policies we've seen from Trump, but not to a degree that you really see in an imbalance. So carry story, I think, continues for next year.
You sound like you're from Brown and Columbia. Nobody understands it. What is a carry year?
Carry, so yield. I think, spreads we're forecasting just to go slightly wider, 10 basis points in investment grade to a level of 85.
The yield.
Take the yield.
Clip the coupon,
clip the coupon, places in credit like leverage loans where you have an elevated level of yields right now compared to high yield and IG, we think are a great spot to be. We also like long duration investment grade, so 10 years and beyond, where you'll have this elevated yield and issuers will still be hesitant to sell supply with longer dated maturities. We think those two spots are a great place to step into yield next year.
In your notes, I've read something that I don't think I've seen, and I can't remember how long. Globally, we like Europe to outperform the U.S. Why?
Yes. So it does seem an out of consensus view. I think that in Europe, we have slower growth, obviously, but that will allow the ECB to continue to be dovish. And a lot of the bad news is priced into European credit spreads. So we're trading a lot wider in Europe compared to the U.S. And then U.S., we're at all-time tights in spreads, and then you have this risk of reacceleration. The Fed potentially has to pause. We think that's not priced into the market yet.
Do your economists see inflation out there? I mean, you got a government in Germany, toast, a government in BNP Paribas, Paris, and France, sort of kind of like toast. I got the shock of Chrystia Freeland in Canada yesterday, going to a possible election early next year. I mean, with all that tumult, can we really give way to a new inflation regime?
I think it's certainly possible in the U.S. I think it will depend a lot on what we see happening with President-elect Trump's policies, and if we do get some of the tariffs that he's talked about, I think that could be certainly a catalyst for a reacceleration in inflation.
Sectors. Are there sectors that screen well for you guys from a credit perspective these days?
So we do like taking some pro-growth policy. We think that less regulation next year does warrant stepping into some of those areas, but where you can also avoid the tariff risk. So we like transportation and investment grade, and then in high yield, our favorite sector is still cruise lines, where
you're killing me.
You have low exposure
to. What's your favorite cruise line? I mean, Si's on a Celebrity Cruises. Okay.
So you have low exposure to lower income consumer, where we have seen risk, and it's a leisure sector. So if we do see tariffs, we see that sector is less vulnerable to goods risks.
Dumb question of the day: are airlines investment grade? Delta, United. We've got JetBlue's executive coming up here today, I believe.
Yep. So we have airlines in both markets, but in investment grade also we have rail. So rail transportation, a major part of the sector, and then a handful of airlines as well.
How about my old stomping grounds, cable?
So
Charter, Compass, they issued debt by the boatload. I made a small fortune with those guys.
So this is sector continue. I think we have to be a lot more selective.
Okay.
More selective in despite
what she just said is, Paul, you're wrong.
Despite the fact that IG spreads are very tight, that is a sector where we've seen more single name volatility, so that's a place we'd be cautious. Another place we'd be cautious is in building products. I think there you see sort of a trifecta of risks in 2025. Immigration, so building products, home building, it's a sector that really relies more so on undocumented labor. If President-elect Trump is going to go after that issue in a hard way, I think that home builders would be very vulnerable there. And then also this risk of rates high for longer could still sort of dampen some demand in housing.
My chart of the year is the price recovery of the blended Bloomberg Barclays Lehman Index. I don't think anybody saw this coming, where we've really migrated from a horrific 6 standard deviation move up into a better place. Can you actually say price appreciation within bonds for the next 12 months?
We're not expecting that. So when we talk
Take
about
the coupon.
when we take about clipping coupons, exactly. I think the story is you just want to protect your capital, and a good place to do that we think is investment grade, the long end, leverage loans. But to find price appreciation, I think is much more challenging, just given the starting point for valuations.
I brought this up. I didn't even know how to do this on the Bloomberg. The Muni key.
Yeah,
Fred Corcoran taught me the Muni key on the Bloomberg with Charlie Gogolak. And the answer here is I brought up the Delta Airlines LaGuardia Airport Terminal C&D redevelopment piece.
Buying it.
You get a 5% coupon. I don't have a price. I can't figure out how to read the screen. But you get to pick up your Uber closer to the gate than if you don't own the bond. That's worth doing it. Meghan Robson, thank you so much with BNP Paribas on transportation and investment grade quality.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us now, William Priest, identified with Epoch for years. You just heard Julian Emanuel with raves about the privilege of working with Mr. Priest years ago. In 2007, Bill Priest released the definitive short read on free cash flow and shareholder yield. It's in English. It's short. DiCaprio was awesome in the movie. Unbelievable. In 2007, Apple was $5 a share. It's now $250 a share. The growth of Apple, revenue, iPhone this and all that, it was mostly Bill Priest, just growth of free cash flow, right?
That's the truth. They also had a lot of new products that took big market shares.
How do you determine good free cash flow in 2025 from troubled free cash flow?
Well, it all starts with the allocation of free cash flow and the methodology thereof. So, for example, in any business, it could be a lemonade stand. We don't have time to go through the lemonade stand example, but at the end of the day, you have to define it. So free cash flow is the cash available for distribution to shareholders after all planned capital expenditures and all cash taxes. Now, once you get that number, there's only 5 things you can do with it. And if you cannot earn an amount of money above your cost of capital, let's say for the sake of argument, your cost of capital is 8, 9, 10%. You have to earn more than that, otherwise you are taking value away from your entity. So there's only 5 things you can do with this dollar cash flow. You can pay a dividend, buy back stock, pay down debt. Those are forms of capital return to the owners of the business. Or you can reinvest and acquire. Now, we built 2 products around this. One was our shareholder yield product, which the book was all about. That was the identification of those companies who basically say, you know what, we can't earn our cost of capital with all of the cash flow that we have, and we're giving it back through one of these 3 forms. That became a $20 billion product.
I mean, Paul wants to get in. We're having a Duke love fest here, folks, with Bill Priest and Paul Sweeney. Paul, jump in here, but the heart of the matter is Bill Priest was lonely when that book came out in 2007.
Well, being a former corporate lender, free cash flow is important because that's what pays me back. So are there companies, what's a company that in your career has been really good about managing their free cash flow?
Well, it comes and goes. There are times when a company should be giving back the money because they don't have the reinvestment or the acquisition targets that make sense. Or it's fantastic for them to acquire. We did the other side of this recently. We have what we call a capital reinvestment product, where those companies who you can identify, and the secret sauce there is this. We have data on thousands and thousands of companies. And the trick is to look at the return on incremental capital, what's called ROIC, ROIC, and look at that compared to the cost of capital, the WACC, weighted average cost of capital. The spread between ROIC and WACC, it turns out in a good company, it persists. And you can look at it with all the data we have data going back decades. Those companies continue to be top quartile.
Okay, so we do that in the Bloomberg on the WACC screen. We're not going to turn this into a CFA lesson, but the bottom line, Bill Priest, is everyone listening and watching is living Mag 7. They didn't exist in 2007. You got, let's say you got the 8th edition coming out. Your chapter on Mag 7, free cash flow, WACC, and ROIC, can they sustain that?
Many of them can. Don't know for sure all of them. The secret sauce, though, is the substitute of bits for atoms. So let's take information. It comes to you in the form of bits. Atoms would be the desk in front of me, this microphone. We're made of atoms. If you run a company and you can substitute technology in the form of a bit for labor, which is a form of an atom, and hold your revenues constant, your margins go up. And if you can substitute a bit, think selling something over the internet as opposed to a physical store, and hold your revenues constant, your sales per dollar of assets go up. So if you were to go back and just look at return on equity, if I can substitute technology for labor and physical assets and hold my revenues constant, my ROIC goes through the roof. And those companies, every company should be focusing on that gap. And how do I substitute technology for labor and physical assets?
Are those returns on invested capital relative to the cost of capital today enough to support this market? We've had 2 years of 20% returns.
Totally agree with you. I think the market has a real valuation issue. We've had 2 back-to-back years of over 20% in the market, and I think that's very difficult. So the question is, can you sustain the discount rate? Is the discount rate going to go up or down? It's going to be a struggle in my view. When you think of when the Berlin Wall fell in 1989, for over 20 years we created the most efficient supply chain the world has ever known. Now we want to go to onshoring. We want security of supply chains, not efficiency. You can't do that without inflation. You can't bring all that manufacturing capacity back here without inflation. That's going to be a burden for the new administration to deal with as well.
You've been around the block a few times, Bill. What do you make of this crypto stuff? Tom Keene is all over Bitcoin. I mean, he's been day one on top of it. What do you think?
Well, I've always been suspicious, and I've been wrong with regard to owning Bitcoin. I've never thought of Bitcoin as being money. So there's a really good guy you should get on your show sometime, Eswar Prasad, ESWARPRASAD.
Very familiar with him. He's been a huge supporter.
Okay, he's fantastic. He is the best guy in money in
It's okay, he went to Cornell and not Duke.
Yes, it's perfectly fine, perfectly fine. But money does 3 things. To be money, you have to do 3 things. Medium of exchange, medium of exchange, a value, has to be a way to measure value. And the problem with money, it is a unit with Bitcoin, it is a unit of account, and it is a medium of exchange, but it is not a store of value. That's the problem. And so you're not going to see legal trade done much in anything other than dollars.
One of your epic portfolios, number one holding, J.P. Morgan. How's Mr. Diamond doing? Is J.P. Morgan is an entity showing good use of free cash flow and good use of shareholder yield?
Well, I would defer to my analyst to a large extent on that, but he's one of the great managers in the banking business. There's no question about that. Right. And anyone that's owned his stock over the last 10, 20 years, they're very happy. Are
we dealing with monopsonistic tendencies in this country where we're just doing a big national roll-up into large cap, a la Mag 7, a la banking dominance of J.P. Morgan and Bank of America and the rest?
Consolidation has always been there. The question is it value add to the buyer? And if you can demonstrate value add, it's probably going to continue. But we have lots of new companies being formed every year. So we're not without innovation.
Can you ask Priest how UNC got Belichick and Duke didn't? You know?
I'm happy with our coach, Manny Diaz. I'm happy with the Duke coach.
Belichick going to 5 years at $50 million or something like that.
Yeah, it's like epic money.
Well, I think what's interesting is will he be able to relate to the players? It's a big difference relating to undergraduates and then.
Yeah, it's like when Bill Priest was Julian Emanuel. He's like, who is this twerp?
Right, exactly.
Get one more question in here.
Bill, did you and your team change your investment outlook the day after this election? Did anything change for you guys in terms of how you think about asset allocation or investment opportunities?
No, we haven't changed anything yet. It's all about finding the companies that are good capital allocators, and I think they will see us through good times and bad times.
Mrs. Keene emails in. She goes, how come Bill Priest is so cut and chiseled? What's the secret? Vitamin D3? What are you doing? You're still working a 70-hour work week.
Well, I wouldn't say it's 70 anymore, but it's a lot. I love the game. The game is incredibly challenging.
Is the game fair for our listeners and viewers?
Yes, but you're going to have to do your homework. You're going to have to do your homework. When you get into the private equity, private credit world, the one thing there is the mark-to-market problem.
Yep.
You're never sure what those marks are. And look, having been chairman of a number of mutual funds who also did do private placements, the accounting firms will never sign off on valuation. What they do is they sign off on the process that you use for valuation. So they may say, they don't want to get sued for misvaluations. But going way back to my days when Julian and I worked together, this is a long time ago, we had a number of closed-end funds in South America, and they did private placements. So as chairman of the board, when we were going over values, the accountants would come in and say, the valuation used by, in those days, BE Associates, those valuation methodologies are valid, but they never signed off on the valuation itself.
Smart.
Bill Priest, brilliant. Thank you so much, folks. Out on Twitter, out on LinkedIn, free cash flow and shareholder yield. DiCaprio will do the movie. It's looking 2027 for Bill Priest Classic. Free cash flow. Can't say enough about that effort.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
It is that time, the daily look at the front pages, the Lisa Mateo Minute. Lisa's on the clock. What do you have?
I have those outlet malls. They're drawing a lot more luxury brands. I thought this was interesting, and I've seen this.
Yes. You did it on Black Friday.
I did.
Yes.
It's the outlet malls because shoppers looking for bargains, right? But they still like the luxury goods. So more are headed to the outlet malls to get those designer shoes, clothing, handbags at more affordable prices. The Wall Street Journal says even though foot traffic's still below pre-pandemic levels, retailers are leasing more space at outlet shopping centers, so they're starting to grow. There's more than 200 of them in the U.S. I didn't even realize that. A lot of them all for this affordable luxury. We're talking about Coach, Marc Jacobs, Gucci, Prada. And what I noticed from going to these, like Woodbury Commons or Jersey Shore outlets, is that the longest lines are at these stores.
Really?
I mean, just wrapping around outside. So more people are doing it. They're saying the reason why is because a lot of these luxury retailers are selling their excess products to places like TJ Maxx.
Yep.
And people are realizing, hey, you know what? I can afford this high-end stuff.
The Economist with an article, I actually read every word of it, and I think they had Versace. I do not have the number in front of me, but I was stunned what percentage of Versace is on sale right now. Because it used to be they were never on sale. Ever, you know.
Right. Sometimes it was said that they would like shred them or do something else, so they would rather do that than put it on sale.
No kidding.
So that was something else in this article.
Are the outlet malls still a thing? Like when you go, are they packed?
The mall's not, you know what? I've been to the mall even during the holiday and it's not that packed, but it's the outlet malls that people are like flocking to. It's crazy. And it's interesting. Next time we have a luxury person, I've got to ask him about this, about the outlet malls and luxury sales.
We have Michael Barr with us almost every day. He's a luxury
He is.
person.
Luxury guy.
Here it is. Why Louis Vuitton is struggling, but Hermes is not. And somewhere in here, this is the Economist magazine, there's, how much of Versace's on sale? I was blown away. It's like a big deal. Right. Next, what do you got?
There you go. Since we're sticking with shoppers who love deals, no, we're not doing the drones. I still have not seen one in New Jersey. But sticking with the shoppers who love deals. So Business Insider says, who is the top downloaded app of 2024? And they say it's actually Chinese-owned e-commerce discount retailer Temu. It's the most downloaded for the first 10 months of 24, beating out TikTok, ChatGPT, all that. It sells everything, tech gadgets, apparel at a cheap cost. Owned by PDD Holdings, particular among the Gen Z consumers, 18 to 24. They love it. They've been downloading it. The big problem, though, is that President-elect Donald Trump, threatening with the high tariffs on Chinese goods. So people are wondering, are they going to start raising their prices to kind of offset that levy? But this is like the big thing.
Is it a TikTok thing where it's Chinese-owned and we're worried that Temu is going to know what our checkbook is?
Not so much. They haven't actually brought that up. That's true.
So Temu has invested millions to market to American shoppers. $3 Temu ads aired during the Super Bowl.
Oh, you remember those?
Wow.
Yes,
Okay.
they did. 3.
Right.
They're like 7 billion a pop, aren't they?
Yep, exactly.
It's crazy.
Close to 7 billion.
Oh,
Okay, next.
Okay, the world's busiest airline routes in 2024. This is a travel comeback for Asia. This is actually a report on Bloomberg. Aviation data provider OAG, 7 of the world's 10 busiest international routes are largely in Asia. This was taken from January to December of 2024, only included the round trip flights. The busiest international flight route was Hong Kong to Taipei, 6.8 million available seats. Then you had Cairo to Jeddah, Saudi Arabia. We talked about Saudi Arabia yesterday. That's the second place. And then third place, Seoul to Tokyo Narita. That was third place. But it's a mix. It's a mix of leisure, a mix of business destinations. So they're starting to see that. And if you want to look transatlantic, the only place in that top 10 was actually New York JFK to London Heathrow. But it just goes to show.
Well, see, what I don't think we're seeing yet is just broader China to the U.S. Like, I still think those, you hear from the luxury folks, you're still not seeing the Chinese consumers coming here into the U.S. and shopping. And I think part of that is because there's just not a lot of flights. It's kind of a post-pandemic thing. I don't know.
That was fascinating yesterday with Stephen Trent of Citigroup. He was leading with Delta, but he's got Panama.
Yeah,
This is
Latin
the
America,
Latin
sure.
American
Yep.
flight. Okay.
Yep.
You got one more for us?
I do. Okay, so starting January
Whoa,
2nd.
whoa.
Yes.
Is it the red one with the rock?
No, it is not. I have to. I actually fell asleep during the movie. It's really bad.
There's
It
your
was-
1-star rating
jeez.
from Lisa Mateo.
And I love The Rock. But this is about your other favorite topic: people coming back to the office, right? So starting January 2nd, a lot of companies are doing that 5 days a week. Everybody has to come in, including Amazon. But Amazon is running into a problem. They actually don't have enough space in the office for all these people to come back. So they're running into this problem. It was seen in this internal memo. You have workers Atlanta, Houston, Nashville, and New York. They're saying they can continue following the 3-day rule until they can find enough space for them. And these delays could go out to May. That's what they're saying. So this is the problem they're having. It's actually not the first time when they actually announced the 3-day week coming back.
So
they had the same problem.
Just to be clear, we're not hybrid, are we? We're back every day, aren't we?
I don't know if it's
we're
4
back
or
every
5. That's a good question.
Well, you and I and Tom.
We're here. We're all
you and
here.
I. Truman hasn't missed a day since the pandemic. The kid came in every day.
Tucker took a day off. I think it was after Lehman.
Okay.
It was just 2010-ish as well. Lisa Mateo, thank you so much. The newspapers.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.